Hi everyone, welcome to another video. In this video, we'll discuss the concept of Employee Stock Options Plan or ESOPs. Well, employee compensation has come a long way and has even progressed far beyond the basic wage system. Wealth creation nowadays has become the common topic, often being discussed even between salaried individuals. So keeping that in mind, in today's video, we'll discuss why companies give out these kind of options to the employees. What are the different elements of the constituents of an ESOP scheme? And finally, as far as tax is concerned, which are the different points at which ESOPs are generally taxed? So let's do a deep dive into each of these three areas and try to understand this in a more simplified manner. So first things first, and that is why ESOPs? Well, before that, ESOPs are options given to the employees to purchase the shares of the company for which they are working for in the future. Now, there could be a multitude of different reasons why ESOPs or options are given to the employees, and the most common of them is retention. That is to make the employees stick to the organization for many more years to come. It could also be to acknowledge the performance of the employee and also to motivate them to deliver the same kind of performance even in the future. It could also be to imbibe a sense of ownership in the minds of employees, because once they have the options to purchase shares of the company, they become as good as the owners of the company. And finally, there could be companies, especially startups nowadays, who cannot afford a high salary for these highly qualified employees, for which they look up to these options, tag it along with the compensation and give it to the employees. So these factors combined with various other factors put together is the main reason why companies give out these kind of options to the employees. In short, to drive the long-term performance of the company as a whole. Now, as already discussed at the start of the video, wealth creation has become a common term amongst salaried folks, and that is all thanks to the concept of ESOPs. Because the value of ESOPs is directly proportional to the value of the company or the value of the startup. That is, as the value of the company goes up, the value of the options in the hands of these companies also tend to rise, also goes up. And that is why companies like Zomato back then, who were the front runners in the food and the restaurant business, witnessed a spike in the value of their shares, because of which the employees back then of Zomato became millionaires, as their value of options in their hands rose in proportion to the value of the shares of Zomato. Well, coming to the elements of ESOPs, there are many elements, but the most general ones are the value of the ESOPs, the vesting period or the period during which ESOPs are given to you during the course of your employment, the cliff period, which is basically the minimum time of employment that you should cross in order to be eligible to get the options, and finally you have the exercise period, that is when you will be able to exercise these options or convert these options into shares. So first is the value of ESOPs. As I already said, the value of your options is directly proportional to the value of the company or startup. Or to put in other words, the value of one share of the company is directly related to the value of the options in your hands. So if the value of one share of the company is rupees 10 and you have two options, then the value options in your hands is rupees 20. Tomorrow, if the value of the company goes up by rupees 5, that is to rupees 15, then the value options in your hands is rupees 30. And that is why I said the value of one share of the company that you're working for is directly related to the value of the options in your hands. Coming to the vesting period, well, this is the period of employment during which ESOPs or options will be granted to you. So if the company has a plan to give you 100 ESOPs or options spread across 4 years, that is the vesting period, then 25 ESOPs in 1 year, 25 ESOPs the other year will be given to you till it reaches 100 options. So this 4 years, nothing but your period of employment or the minimum lock-in period, otherwise called as a vesting period, during which you'll be given these options, after which you'll be able to exercise your options, convert them into shares. The other concept is cliff period. Well, cliff period, in contrast to the vesting period, is the minimum period of employment that you should serve with the company till you become eligible to get the options in your hands. Or in other words, from the day you start your employment, you need to cross a time of period in order to be eligible to get these options. Normally for companies, it is 1 year. Coming to the exercise period, Well, the obvious question is, when can you exercise your options? So once you have completed your cliff period and your vesting period, then comes your exercise period. There will be a particular date called the exercise date, on which at that particular exercise rate, you'll be able to convert your options into shares. Well, before we look into the tax part of things, I'll just summarize the whole game of ESOPs. So if you are the employee of the company, and once you've completed your cliff and your vesting period, you'll be undergoing your exercise period, and at the particular date you'll be exercising your options, for which you'll be allotted shares. Once you get the shares, you'll be looking forward to sell these shares, liquidate it, and get money into your bank account. Now the real question is, when can you sell the shares, or when can you liquidate these shares? Now if you are the employee of a listed company, it's very simple. In the share market, the open market, you sell your shares and liquidate it. But what if you are the employee of an unlisted company or a private company? Well, in those cases, you have different situations in which you can liquidate your shares. If you're part of a successful startup, then most likely it'll go for an IPO, and at the IPO, you can liquidate your shares. Even before the IPO, the company has brought out a buyback policy wherein they will buy back the shares allotted to you and pay a sum of money in relation to the value of shares held by you. Then that is an opportunity for you to liquidate your shares. There could also be a situation where your company is being acquired by a second company, and the second company is willing to pay you money for the value of shares held in your name. So these could be some of the situations in which you could think of liquidating your shares if you are an employee of an unlisted or private limited company. Coming to the tax part of things, well, there are two situations in which income tax will be levied. The first scenario is when you exercise your option, that is, you're giving up your options and getting shares. This is sort of a deemed benefit because there is no actual money coming into your bank account. In contrast, there are shares coming into your name, and therefore this will be taxed as perquisites in your hands under the head salaries. And when you get shares and when you think of liquidating the same, then yes, the gain or loss will be taxed under the head capital gains. To understand these two situations in depth, let's try to take the help of examples. So the first scenario is when you're exercising options, that is, you're giving up options and getting shares of the company. Say you have 20 options in your hand. You're working for the company, and the fair market value of one share of the company is rupees 100. You get the privilege of exercising at a price of rupees 90. The difference between fair market value and the exercise price, that rupees 10 difference, multiplied by the number of options you have. So basically, 200 rupees is your deemed income, taxable as perquisite in your hands as under the head salaries. The second scenario is when you actually have the shares and you're selling it either through the IPO or share market or secondary sale or whatever. In that case, you look at your selling price, which is rupees 120 in this case per share. You initially purchased it at rupees 100 and say you hold 10 shares. So rupees 200, which is basically a gain in your hands, will be taxed as capital gain under the capital gain head. Well, I hope I was able to make things clear through this particular video. If you like this video, please do show support to us by hitting the like button. If you want more videos like these on a regular basis by way of notifications, you could also think of hitting on the subscribe button. Till then, I'll see you guys in the next video. Take care and thank you.